Campbell stock fell on earnings. Is it a buy? Today, we're going to look at some of the headwinds facing the company. We'll look at some of the reasons for future optimism. We'll also take a look at a valuation. I'll tell you what I think the stock might be worth. And we'll take a look at some of the technicals around the stock to see where a good entry point may be. Now, as a full disclosure, I am a Campbell's shareholder and also have some leaps out to 2027. But my answer about whether I think it's a buy right now may surprise you. Welcome to the stock sale flyer. So here we can see some of the brands that Campbell's owns. You can see it's not just Campbell's and their soups, but also Rayo's, Prego, Pace, Swanson, V8. They also own a lot of snack brands like Goldfish, Cape Cod, Kettle, Snack Factory, Snyder's Pretzels, Pepperidge Farm. So this is not just a soup company. And in fact, they renamed the company the Campbell's Company not too long ago. On earnings, the stock dropped. You can see they did beat on adjusted EPS and on revenue, but the numbers fell year over year, and the stock has been under pressure. A big reason for that is because of headwinds the company's been facing. As you'll see in the valuation I'm going to show you, they've been facing margin pressure, and their margins from inflation and tariffs and things like that have been taking a hit. They've also seen weaker snack demand. There's been a lot of talk about GLP-1s, people snacking less, and that has hit the company as well. They're seeing sales decline. Overall sales dropped year over year. They're also facing intense competition from other brands, including private label brands at stores like Walmart and Costco. So think like Great Value and brands like that. They issued cautious guidance. They reaffirmed a lower full year outlook as a part of their earnings report, and they've been facing supply chain issues. Now, despite the headwinds the company's facing, there are some reasons for optimism for the future. They did beat analyst expectations and posted an earnings beat for the first quarter of this 2026 fiscal year, despite the fact that adjusted EPS did decline year over year, and so did revenue. They did at least beat analyst expectations. We also looked at the brands, the strong brands earlier in the video that they have, and the fact that meals and beverages is a resilient category. Those two things should help them as well going forward. People are spending less money at restaurants as well, and there's a trend for more at-home cooking, so that should help Campbell's as well. They're trying to implement cost saving initiatives, so they are trying to improve on their margins with more efficiency in the business. And there is a consistent dividend, which hopefully will provide some support for the stock as people uh, will invest to get that consistent dividend every quarter. There was an interesting piece of information from the earnings report I wanted to point out. Campbell's made a strategic investment in La Regina. This is the proprietary producer of Rayo's tomato-based pasta sauces. They're purchasing 49% of the company with a call option to buy the other 51% if they want to in the future. And they noted that this should improve the margins of the Rayo's brand. They said they'd get the full gross margin impact from the purchase. It'll be significant for Rouse, obviously not terribly significant for the entire company, but will have a very favorable impact on the brand. I like this purchase because it'll improve margins. I think it'll help protect the Rayo's brand, and it will help them really have basically more vertical integration in the brand. So by owning at least part of, if not all of the proprietary producer, I think that's good for the Rayo's brand as a whole and will help them grow the brand. Now let's take a look at my valuation on the stock. The first thing I want to point out are those lower net income margins for fiscal year 2024 and 2025. If you look back at fiscal year 2023, 2022, you had higher net income margins in those years. So in this valuation, I have factored in the net income margins improving some, not going back to the 2022, 2023 levels, but having some improvement in future fiscal years. I have a negative 3.25% revenue growth rate for fiscal year 2026. Revenue was down about 3% in the first quarter. And I did look at analyst expectations when coming up with this number for revenue for the fiscal year 2026. I then have 1.11% revenue growth for fiscal year 2027. And then I went with 2% growth in fiscal year 2028, 2029, and 2030. I did just a 1.5% perpetual growth rate here. So factoring in not a lot of growth at all with this company, really. And I overrode the weighted average cost of capital because I thought it was such a low number that the required rate of return didn't really make a lot of sense. So I overrode that number and I went with the return of the market of 10% for my required rate of return. That's my discount rate. And I used the shares outstanding from the 2025 10K, which you could see here. I don't use the most recent share count number because the fiscal year 2026 still shows up on this valuation as a future projection because the year's not over yet. So I go with the number from the last annual report. And then I adjust free cash flow for stock-based compensation. I get a fair value of equity of $30.22 with this model. I also looked at it at different PE ratios if the net income number for fiscal year 2030 holds true, and this is the same number of shares outstanding. I did also take a look at the current quarterly dividend, assuming that remains stable and there's no changes, and there's 19 more quarters out to the end of fiscal year 2030. You can see that after fiscal year 2030, your price of the stock plus the dividend total at different PE ratios would be what you see here. So let's say this stock traded at a PE of 12 and a half after fiscal year 2030. You would have a share price of $33.81, plus you'd have 19 quarters of dividends of at least 39 cents a share if they don't grow the dividend at all and they don't cut the dividend at all. So you'd have a price plus dividend total of $41.22 a share by the end of fiscal year 2030. The stock closed today at $28.43. So not too far below the fair value of equity, and in a 5-year return, unless you see some more multiple expansion, not really a fantastic return. Now, for that reason, if I were to add to the stock that I own, I actually would be looking for more of a margin of safety from here. Why is that? I think the headwinds are maybe stronger than I built into the valuation before I originally bought the stock. My cost basis is between $30 and $31. Now, looking at the stock some months later, if I hadn't purchased the stock already, I would probably be looking for lower prices. If we look at the technicals, we can see that there's actually a level that lines up pretty well with this 20% margin of safety number. This 20% margin of safety number is $24.18. And if we look at the chart, this is a monthly chart. If we draw a Fibonacci retrace from this low all the way back in 2002 up to and this is the beginning of what I would call an uptrend here. And we have the top of the trend back in 2016. You can see that I really thought that this 786 Fibonacci level here would or might hold. That's what I was thinking. So you can see back in July, it reacted positively to this level. It had an uptrend and then it sold off again. And it seems like it tried to hold this level. And we almost had like a wedge, a broadening wedge pattern here where we have these trend lines. And it seems like it really tried to hold this Fibonacci level, but on earnings, it really just broke down. It lost this descending trend line. And then today, it had a positive move. It actually reacted, if I bring the daily pivots up, it actually reacted positively to that daily S2 pivot level you can see. But then as it went up against that descending trend line, which is now resistance, it didn't react so great to that level. So it'll be interesting to see if it makes another run at this trend line here and tries to get back above this Fibonacci level, or if it does what I think it will do, and that's to roll over here and actually test this lower support level, which goes all the way back to so a level here from 1995, and this level goes through here. You can see it was held as support around 2000, and it got below it, but then reclaimed it in 2003. It retested it again in 2009. So this is a long-term support level here. If it does roll over here and tests, that 20, it's the line I have it drawn at $24.44, but around the 24.50 level. If it does test that level, I would think that would be significant support, and it would line up pretty well with that 20% margin of safety level I have here on this valuation. So that's an area where I might be interested in adding Some shares, and if I didn't already have shares, then that would be a level I would be really interested in, just me personally. I do think there's a chance that it could, depending on the market overall and how things go, if dividend stocks, are back in favor, if consumer staples get into favor, I could see this running back up toward $40. It's tough to predict price action. So for me, it's a hold. I'm not going to sell the shares I have now. I'm also not going to add to the shares I have. I'm just going to collect the dividend and see where this one goes. But I do think that that level around 24.50 would be interesting if the stock decides to test that level. I hope this was helpful or informative. If it was, please click the like button, subscribe, follow me on X at Stock Sale Flyer. Don't forget to click the bell for notifications. And if you missed my videos on PayPal and Crocs that I released recently, make sure you check those out as well. Oh, and leave a comment too and tell me what you think. Thanks, guys. Bye.